is more of the health crisis rather than a financial crisis. So the market also has some very strong anticipation that, you know, either it's a vaccine or medicine that can help to resolve all the social distancing so that life can back to normal. So if we look at the next slide, Sophie, please. First is that the KLCI, you know, the KLCI slide. The next one, yes. This is a comparison of KLCI, right? How it performed, you know, taking that when the 30 days before the, not 30 days, sorry, it's about 60 days before the crisis start, and then the crisis hit, and then when it hit the bottom, we can see that it does have certain similarity with the financial crisis, right? Although financial crisis, we see a double bottom. So this round, it hit the bottom and it start to come back, right? As compared to the SARS. SARS also, actually, you see after the yellow line, after you see that it hit the bottom, then the market recover and subsequently actually it go higher than even before the crisis hit. So the same thing, the same question is exactly, is it really a disconnection, right? And of course, the very difference this round is that SARS, that time was actually more of a very localized, it's just in Hong Kong, partially China, and just a few countries, whereas this COVID-19 is a pandemic, right? So because of that, that's why a lot of expectation on the vaccine, which you can see on the next slide. There are plenty of, I mean, this is not by means comprehensive. We know that a lot of companies are developing the vaccine, and most of them also targeting probably by end of this year, because September, I think, is a bit ambitious. But once there's a vaccine, right, everybody will presume economy will be back to normal. But even with that, there's one question that is still left for probably Khai Jhek to answer. Go to the next slide. Is that currently, right, the production capacity, right, probably is just only enough for the developed countries, right? Although you may argue China is not developed countries, but they have a very strong technology, also like Russia. So the question is, first, will the vaccine, even if it's successful developed, were the emerging countries like Malaysia able to receive the vaccine as fast as possible, and the world will move into recovery in a synchronized situation, or we are behind the developed nation, which we may lag about 6 months or even a year before we recover. Less to speak about the cost of vaccine and how it will affect the government fiscal spending. So with all this, I think I would like to welcome Khai Jhek to share his view on the macro economy of a Malaysia situation and how we will move forward from there. So Khai Jhek, the floor is yours now.
Right. Thank you, Mr. Phua. Let me share my screen first. Okay, so as I think as Mr. Phua mentioned, I'll be covering more on the macroeconomic side. Most importantly, as to maybe we can take a look at how the COVID-19 pandemic has actually affected the overall economic performance around the world, with a specific focus on Malaysia, since we are in Malaysia currently. So before that, let's start by maybe we can have a look at all these shapes. I guess it's quite a popular question nowadays. I guess most of you can already guess why am I showing all this shape. Is that I guess it's one of the million-dollar questions among all the maybe the market analysts as well as the investment community as to what would be the potential shape of recovery be like once I wouldn't say once COVID has passed, because even without fully resolution of the pandemic, we have seen some slight recovery. But I guess this is some food for thought. I mean, as Partly also I'm outsourcing my job now, so you can make your own decision as to what will be the shape of recovery be at. Maybe once we completed the presentation, maybe you can have a vote or something like that. So move on next to my I guess key presentation highlights for tonight. So we'll be especially looking at the COVID-19's impact on the global economy, and then we'll be focusing on Malaysia, and we can look at maybe how is the crisis different this round, and where's most of the source of the downturn coming from this round. And then something interesting would be we can also review some of the policy supports that the Malaysian government has gone on so far, and maybe some of the look ahead. We can share some of the RAM's forecast for this year. So first thing first, the global pandemic has actually brought about quite unprecedented situation towards the global economy, which quite a big downside impact to economic activities. So as a testament to this downside impact, we have actually seen that the IMF has actually revised its global growth forecast sharply downwards to 4.9% contraction from an already weak 3% contraction. So it is quite, I guess, telling to say that even IMF has been isn't really looking that well into 2020's economic growth. So the revision can be seen across most major developed economies, like even the US is a sharp down revision to -8% from -5.9. And I guess the bright spot here, I wouldn't say bright spot, but the only positive news here is that China is the one that only got upgraded, although only by 0.2 percentage points. But even then, if you look at this 1.2% growth is very, very weak compared to its past performance, which has historically averaged around 6 to 7%. So this will likely be maybe the deepest recession since the World War II. So on to Malaysia. Malaysia has actually recorded a historical level of slowdown during the MCO. So we can see like the most recent second quarter GDP result release, it came in at a 17.7% contraction. In comparison, like even during the height of GFC, it was only a 5.8% contraction. So across the board, you see all the subsectors experience sharp contraction, including your manufacturing, even electricity growth. And it also impacted your financial market. So like if you take a look at the local bond market, foreign outflow, just from February to April, it was already at 22.4 billion worth of foreign outflow, compared to during the global financial crisis, it only reached that value at 8 months' time. So I guess the outflow this time was sharp and large magnitude. Another thing that we can also look at is that the crisis this time cannot be directly compared to maybe the most recent crisis, including your global financial crisis as well as your Asian financial crisis, due to a few reasons. So maybe like say, location-wise, you can see like global financial crisis actually originated from the United States, and mostly, I guess the largest impact would, more towards the US as well as the Euro area, while the Asian financial crisis is largely concentrated in Asia and the ASEAN region specifically. Other than that, there's also the geographical linkage, in the sense that currently, globally, the economy has been more connected than ever, and also the fact that Malaysia is actually a small and open economy with and it's very, very integrated into the global supply chain and the global production chain. So I guess we can change the saying that once China sneezes, Malaysia also catch a cold, rather than last time it used to be just US. Yeah. So other than that, like I guess one of the main difference also is that the crisis this time around is both a supply side disruption as well as a demand destruction kind of crisis, rather than in the past where you see people going out of jobs and it hurts the demand. This time around, there's an additional impact coming from the various lockdowns that I guess most of the governments have been trying to implement to actually control this health crisis. So an unintended impact from these lockdowns is that it grinded the economic activities to a halt. So as you can see from the left chart, the stringency index actually shows that I guess movements has actually been very much restricted during the height of the pandemic. So that actually contributed to a lot of contraction in output across all the sectors within the countries. So from this supply side disruption, it subsequently turned into a demand side issue as the slower economic activities actually also helped to generated more job losses as well as hampered further demand for production output. So all these forced closure factories globally also actually impacted the external demand for Malaysia. So you see like the second quarter actually export numbers isn't actually looking very well with quite a sharp contraction. So, however, recently we've seen some loosening restrictions that we also observe in some of the more recent data releases that there is actually more economic activities, even though it hasn't really, we wouldn't see it has actually recovered to pre-COVID levels. So like maybe in the RMCO, you actually see more industries allowed to open compared to when maybe during the first or second phase of MCO, where only very limited essential industries are allowed to open. So as we can see in the next slide, based on our capacity utilization estimation, you can see that the utilization is actually very low during like the height of the MCO, maybe in April, and subsequently it's recovered a bit in May. Also because it's also consistent with the fact that in May we have the CMCO, which more industries are allowed to open. So I guess the key to the recovery is also that there isn't any much more lockdowns that would actually compound upon this economic weakness. So another interesting, I guess, trend that we observe is also that there is this appearance of a dual speed economy in Malaysia. Based on our, I guess, our estimate, you can see that generally you see the essential manufacturing actually performs relatively well, much more better than the non-essential manufacturing. So I guess this is also part of the, due to the reason that only essential manufacturing were allowed to open during that time. So, but we have seen that the utilization have gradually recovered in June. So June is actually, based on the available data so far, it has been the, I guess, the strongest growth that we've seen since the MCO started. For the next slide, we will also look at the labor market. So I guess the most damaging aspect of COVID-19 has been the job losses. So the pandemic actually took out a lot of jobs based on what we've seen in the data so far. And this is also partly why I guess production or even retail demand hasn't been as strong because of the weaker labor market. So as you can see from the employment or unemployment growth, it actually peaked in April and May at close to about 50% year-on-year increase, which is quite significant. And this has actually also contributed to quite a lot of softer demand that we've seen, because typically retail sales has actually been quite resilient in Malaysia. So however, if you look at the loss in employment would be even larger if we take into account of population that actually drop out of the workforce, because unemployment only accounts for those that actually are still actively looking for a job. So if we account for those that actually drop out of the workforce, there's been a strong uptrend in people that is considered outside of the labor force. I guess some of the population or some of the workforce might have been, I guess, a bit too dejected about the economic situation. They decided to just stay at home and maybe be a work from home kind of arrangement, or not really a work from home kind of arrangement, but they just decide to not work, or they could just decide to further their educations or etc. So I guess one of the most important statistics that the share of working age population that's not formally employed currently is at 35.3% in June, which is relatively high compared to the historical of about 33 to 34%. That on itself is already 8.2 million of the Malaysian population. So we lost quite a big chunk of the source of demand for Malaysia. And also, bulk of the job losses actually concentrated in the more of the low wage cohort, which spend a larger share of income on necessities. So this further reinforces the idea that the spending this year might not be as strong as in the past. Sector-wise, most of the, I guess we can guess, is that the tourism sector was the most hit the hardest, given that I guess it's the most affected sector so far. Followed by manufacturing, also because I guess most of the restrictions has, I guess, to a certain extent, forced most of the manufacturing firms to actually lay off their employees. Next, we can look at the, I guess the Malaysian government hasn't been just standing still and not doing anything to try to moderate the impact. So there has been quite a few stimulus packages that was launched so far. Like maybe back in February, there's a pre-2020 worth 20 billion package, and then there's a 240 billion package in March and April, then a further package in June worth about 35 billion. I guess most of the initiatives are actually skewed towards businesses, which also makes sense given that most of the businesses are heavily impacted by the various stages of MCO. So even though they want to do business, or they try to do business, they couldn't, to a certain extent. I think of note would be the pre-ITIN package, which there is a larger share of measures that goes towards the household. So to a certain extent, it's more of like a, I guess, direct cash injection to help support some of the more vulnerable population. So based on like the breakdowns, most of the, I guess, the support will come from financing support. So maybe like your loan moratorium or even your wage subsidies that will make up the bulk of the support from the government. I guess the look ahead will be, RAM actually projects the 2020 GDP growth to come in at -4% from a positive 4.3% in 2019. So it is quite a sharp contraction, given that even if you look back at global financial crisis, it was only at -1.5% in 2009. So it also shows that, I guess, reinforcing the points like maybe by Mr. Paul, or even what we have seen in the beginning of the slide, is the current crisis is quite unprecedented. So also, like maybe if you look at even the vaccine solution that Mr. Paul has shared, it remains, I guess, a big question mark currently, that whether the vaccine solution will come soon, and whether the recovery momentum that's seen so far would be constrained by the availability or the unavailability of the vaccine for Malaysia. So that one would be, I guess, a big uncertainty for us so far. Additional uncertainty would be like maybe the ongoing US-China relation, which hasn't been as progressing as positively as everyone would like to. Other uncertainty would be like maybe the labor market damage. Would the stimulus measures targeted towards household be enough to actually support the overall consumption or even the overall economic activities? I guess another uncertainty would be also the COVID-19 development in Malaysia. Like we recently seen some new clusters where, if we actually go back to even stricter MCOs, that might also put a constraint into economic growth in the second half of the year. And also, given the fact that this, I guess I've emphasized this word quite a lot of times, it's an unprecedented health-induced crisis so far. So whether the tried and tested policies that we've seen, like maybe even the OPR cards or even the rounds of stimulus measure, would it be enough, or would it be good enough to tackle this crisis? So I guess we come back to the same slide. So what do you think would be the recovery shape at? So I'll leave that. Maybe we can discuss it later if you wanted to, but I guess it's a food for thought. Yeah. Thank you.
Okay. Thank you. Thank you, Khai Jhek. You have shared with us a very interesting outlook, but it doesn't seem to be that positive for the time being. Well, I think probably I will have some questions that I will ask you later. But in the meantime, with your economic outlook, then it really goes back to, is our market or even global market, is it really overheated, in a sense that, especially for those who are talking about value investing, I think this year has been very challenging for them. Most of the time, I think they are more towards underperformance. So the next speaker, Heng Chuan, he will share with us how he looked at this, the valuation, the value investing. Is Malaysia market over positive, over optimistic, or is it like always people say, share market is always at least 6 months ahead of the economy, where they already factor in a recovery. Of course, what drives the recovery, maybe we can discuss this later. So Heng Chuan, the floor is on yours. Is the market really overheated, or is it really a disconnect between the market and the economy? Okay.
Yeah, thank you, Phua, and thanks CFAI for inviting me to share my findings on this growth and versus value investing during the COVID-19 pandemic paper. So this is actually our paper that are published in the CFA ARX. So there's a link there. You can actually go and take a look if you have time. So this is actually a collaboration between me and also MP Capital. So I'm the author, and also Jaccob Thomas, the CEO of MBCAP, and also Ying Ying to co-author this paper. So let's do the next slide. So today we will actually talk about the outline. Today will be the preamble. Preamble is actually what Phua and also Khai Jhek has presented just now. Is about the economy and what happened currently. And then after, I will briefly go through that because most of them already covered by them. And then next we'll go to our paper on the growth versus value investing during the COVID-19 pandemic. So we'll talk about our motivation and our methodology, how we're doing that. And then we'll go into our objective and also what are we really working on in our research. And then we'll discuss about our key result. There are about 3 to 4 pages on our key result. And then we'll recap with a discussion. So after this, we will also do a further research on the performance by sector, and also PE shift and a sector dissect on our further research, which is some of my paper is actually ongoing right now, but I can give a sneak preview today. Now, so let's look at the performance of the KLCI from 2018 to August 2020. So KLCI actually hit 1895 in 2018, and then you can see that since 2018 it's actually gradually going down already. So that time there's still no COVID, which means that something happened in Malaysia already. So this is one of the risks that we have to actually look at it. So starting from 31st December 2019, our KLCI is around 1586. So that time you already start to hear that China have some COVID kind of thing happening, but Malaysia is still not very severe. But then you see a sharp drop from, not really a sharp drop, I mean acceleration of drop from December to February. So that time Malaysia haven't seen any much of the COVID cases yet. So why you see a drop over there, I think a lot of people know it's due to political issue. So in February to March, right? So you can see a very, very huge drop. That one is we start to have a very severe cases spike in already. That time the most famous term will be the exponential growth of the cases, right? So you start to see all the curve, everybody talk about that and how to flatten the curve. So it actually dropped all the way to 1219 at the 11-year low on March 2020. Then since then, you see a very strong recovery starting from there all the way up to 1564. Indeed, actually breached 1006 few days on July, but then it actually consolidate a bit on 14 August. It's about 1564. So you read from newspaper, you see that people, because of all the retailer, since from KJ result just now, you say that retailer activity is still sluggish. So what are the retailer do when they are locked back in home? So their theory say that since they have nothing to do, so they try to go into the market. So this is one of the theory. But then just the retailer itself, do you think it can actually push the market so high? Do you think the institutional just sit back and relax? If you look at the Bursa daily participant, they are actually 50-50 over them. Then some people also say that maybe short selling is prohibited right now until end of the year, and then margin financing is relaxed, so there are more participants coming in to push the market up. But bear in mind that there's a net outflow of a foreign investor in Bursa. So up to year to date is about 18 billion based on the research report from the MIDF up to 27 July 2020. So where is KLCI heading to from now? So can we try to look at historical data or historical crisis on the AFC or JFC to look at US recession performance and how long the impact to the market to gauge what really happened? So on the next slide, you can see that this is another information gathered by another CFA charter holder, Ben Carlson. I think most of you already know all this information is readily available, and also Phua just now also showed the chart to us. So the average plunge in the above cases was around 59%. Less severe recession, the drop was around 27%. So on a shorter period of time, there's less than 10 months, you also see a 16% plunge. Then Schiller CAP is now at 31.3, where historical mean is 17.1. And then the Buffett indicator is 150% above GDP. So you may classify it as expensive, but can we really judge based on this US recession or depression on all this past data to say about, to predict where the market is actually heading to? So my personal view is, if you look at AFC and also the GFC, right? So what actually causes the recession and also the market drop? Is actually the finance and economy are the root cause. During that time, you already, Lehman Brothers and all the excessive debt is actually already, is something that you need to solve, you already know. So it's actually causing a problem to the finance and economy. Whereas for this time, in the COVID crisis, right? Finance and economy are actually doing quite well before it happened, right? So what is actually causing it is actually the virus and the COVID. So you can say that the finance and economy at this now is actually victims. We are not the root cause. So can we solve finance and economy problem in order to avoid recession or whatever? It's actually debatable. So it all depends on when you can get the vaccine, when you can get a cure for these viruses, and then what we can do from finance and economy perspective is, since we are still in good shape, banking sector are all in good shape, we can actually, what we can do is just react to the lockdown and all the economy inactivity. So Fed actually doing a good job. Everybody praised them. Even Warren Buffett also praised them. So unprecedented, they pour a lot of money into the market. And then you have a lot of stimulus packages. So, but then with this move, is it enough or justify the market movement? Let's look at other risks. So the risk of the stock market, or I mean the economy right now, beside what is going, beside the COVID, right, we actually still have trade tension. So it's getting hotter right now. And then also we have to look at the GDP, whether you're going to see a VUL, and then KJ just now have more shape like shoes, W and Z shape, right? So which one will choose? Which one will happen? So my personal view is, you overall by average, I mean, you will see segment by segment, different segment will actually recover at a different speed. Then when you overall combine them by average, what the shape will look like. So this is my then for investor point of view, you have to look at by sector basis and by segment basis rather than economy as a whole. So then another one with interesting risk is, will the interest rate or the quantitative easing by Fed, right? If you look at the chart over there, over the past 20 years, is almost like a linear straight line. But at the March of 2020, you see a very large spike at the tail end there, right? And it's still spiking. So lately, it's slightly toned down a bit. So the question here is, how long the quantitative easing can go forever? You start to see US currencies depreciating already. So how long this will take? And then how much stimulus you can go on, Penjana, and then you have Prihatin, you have US, you have CARE. And then you have a lot of people rushing for vaccine, and then when we're going to get implemented. And then, as I mentioned previously, we still have political issues in Malaysia that you still very uncertain. So we do not know whether how long this will last. So we actually did a lot of analysis on this. So one of our analysis will be on the investor point of view. Will be, can we look at growth and value investing at this juncture to see that how are we going to adjust our portfolio? So let's look at this. So the motivation of our research over here is actually inspired by Professor Aswaf Damodaran. So Damodaran is the valuation guru. I think everybody in CFA, we know that we know that our valuation model, DCF model, actually most of them come from him. So starting February, right, Damodaran actually started a series of analysis on COVID-19 pandemic impact on the stock market. So until today, he has already 12 articles on it. And most of his work in his blog, which is called Musing on Market, right? If Google, you can find, is actually presented in the 73rd CFAI virtual conference as well. So I actually go through the video and actually go through all his analysis, and I'm really inspired by his work. So one of his work over here is a viral market update, series number 8. So the 8th revision is a crisis test on value versus growth, active versus passive, and small cap versus large cap. So our study over here is actually, I take his framework on the value versus growth. I do it on the growth versus value investing on Bursa Malaysia itself only during the COVID-19 pandemic. So in his work, he actually do a global kind of analysis over 36,000 stocks. So he has a very huge database to analyze with. Whereas our study over here is we only focus on 885 stocks in Bursa Malaysia. Then his methodology on the value versus growth is actually also using trailing PE and PB, DY, and net debt ratio. And one thing is he actually never specified the period of the ratio mentioned. So we do not know whether the PE he stated there in his analysis, right, is actually on June, March, or January. So our analysis over here is we slightly different from his methodology. Is we actually segregate our ratio into a different period, which is January, March, and June. Why we did so is because initially when we started our analysis, we actually used our June PE in order to look at the performance. But then during that time, all my result is actually in line, exactly in line with what Damodaran did. Then after I think about it, actually it's not really that informative, because in January timeframe or in February timeframe, when you start to sell your stock, right, you base on January, February PE, or you base on June PE. So this is a very important question. So I think most of the time you should look at January PE or February PE during that time. And then during the market rebound, when you want to go into the market and buy, what PE you're actually looking at? Maybe during that time you use January PE, probably. If it's not updated, then probably you might want to use March PE. So unlikely you're going to use June PE, because you don't have June PE unless you do a DCF forecast to predict that you're going to have a V shape or U shape. That's another method of doing it. But then our analysis try to see that whether any difference when we are using January or March or June PE. So because there's a lot of data need to rearrange, so we actually write a Python code in order to do all the analysis. So in Damodaran's work, right, his data all shows that growth actually performed better, and then low debt is also preferred. Whereas in our analysis, once we look at a different range, right, we see that growth versus value actually inconclusive. And then, but what is same with Damodaran's result is actually the low debt is actually preferred. So let's look at our research. So our research performs were examined from period, as I mentioned, January to June. So this was segregated into 3 ranges. So the range 1 will be from January to March, mid of March. So I'll call it a range 1 as a sell down, during the sell down. And then range 2 will be from March onwards up to June, because our paper published on June. So the data is only up to June. So we continue to monitor this situation up to today, but definitely we were going to publish our result on research on from June to September, by the end of September. And then the consolidated period on range 3 will be from January to June. So we are going to use PE, PB, DY, and DE. So let's look at the result. Now this is our key result. So we have 3 different range over here. So if you look at the PE, January PE on the most left-hand side there, right? So which PE range actually get hammered down the most is actually 0 to 5. So which means the low PE get hammered out a lot, whereas you have those PE that in the range of 15 to probably 100 is actually not really much, although they still get hammered down systematically, but they are not that severe compared to the low PE. And then negative earning also get hammered out severely. And then from range 2, if you look at the middle graph, right, in March PE, if you're using the March PE to gauge, right, March PE at 0 to 5 actually performed bad. It's almost 80%, by average 80% of our return. Whereas on the higher PE side, you actually get lower return. So after that, if you look at the comparison, so the third graph is just look at the comparison between the January and the March PE. So our conclusion, I mean our observation over here is actually growth stock actually perform better during the sell down, whereas the value stock actually perform better during the rebound. So in a nutshell, you can't really say that which is better and which is poorer. So we do the same analysis on the PB as well. So the PB also have the same thing. So if you're using the January PB, right, the low PB actually do worse. Whereas on the March PB on the center graph, right, the March PB actually, the low PB actually perform better. So again, growth stock perform better during the sell down, and whereas the value stock perform better during the rebound. So which one you choose? You want, are investor focus on growth or investor focus on value? So it's inconclusive based on the data right now. And then for DY, so DY is a very pretty interesting kind of thing. It looks like high dividend yield stock is actually perform worse by average compared to the low dividend stock. So probably even though in the March time frame, right, the performance of the low DE stock also outperformed the DY. So the growth stock from this point of view is actually growth stock actually perform better, but we would say that maybe due to short period of time, DY is more on for the longer term of investor to look at. So during the short period of time, probably DY is not of the factor that actually the investor actually looking at during the pandemic period. Now DEY is actually very clear cut. All these negative equity and all this very high debt to equity ratio, you can see that they get hammered down a lot. Whereas you see that the low zero debt and also the very low gearing stock actually perform better than the high gearing stock. So the same things goes to the March PE as well. So we get the same conclusion as the low DE actually perform better during this different period. So just to recap what our study. So PE, growth stock, high PE perform better during the sell down, and the value stock, low PE perform better during the rebound. PB, same thing, growth stock perform better during the sell down, whereas the value stock perform better during the rebound. And DY stock looks like growth, low DY perform better, and then for the debt ratio wise, low DE actually perform better. So since it's a very inconclusive kind of result based on our data, right? So we are in the opinion that the sector or team base are actually in focus rather than relative valuation. So we actually did further analysis on that. Let's look at the performance by sector. So we actually look at different period You have January to March, which is in the yellow, and then March to June, which is in the purple, and then January to June performance, which is the beige color, and then January to August is the orange color. So clearly, you know who are the winner. I think everybody knows, since they are very hot right now, even though any layman also know that what they're looking at in the stock market right now. So what are the second best performance is on the technology sector and also telecommunication sector. And then who are the worst performer right now? I think financial stocks still not perform very well if you look at it. So year to date there's still a negative 12, and then other sector is a lot of sectors actually year to date is still in the negative region. So we further segmentize this into the PE region. So what we see is the PE shift and sector dissect. So this is the additional analysis that we did. We actually did to change a lot of our code in order to come up with this data. So let's look at the number of PE range. So the 0 to 5 range. So we actually segregated them into January, March to June, right? So the number of stock in each PE range, if you look at 0 to 5, right? In January, there's only 26 of them. But whereas in March, you have actually 105 of stock is actually in this range. And then, what does it mean? It means that there's actually a lot of high PE stocks in the January timeframe, right? Actually get hammered down to become a lower PE range. So what does it mean? It means that those high performance growth stock actually suddenly become value stock from the PE perspective, right? In the March timeframe. And then does investor just because of this high growth stock go have a cheaper valuation, they just rush in and buy? Actually, no. If you look at the data we have on the bottom table, right? If you look at it, it actually is on the next slide. So you can see that which of the sector that actually get hammered down. You see basic material from 2 increase to 11. Consumer cyclical, as you know that consumer did in line with the economy data as well, you can see that they actually get hammered down and then go to the 22. And then you see that financial stock also increased, and then also industry. Then you can see there's no telecommunication and utility stock in this row. So what will happen? So let's just focus on the March PE on the 0 to 5 range, right? And then we see that how many of them is actually from 0 to 5, 5 to 10, 10 to 5, and 15 to 25 in the January timeframe. So which category in the January timeframe actually perform better? So if your stock is in, if the stock PE is January is in 0 to 5, and then at the same time in March PE is still at 0 to 5, which means that they are incumbent. So which means the incumbent, what is the incumbent performance? It's actually only 68. Remember that from the previous slide, I already shown that the average performance of the March PE of 0 to 5 is about 80, which means that they are not the one that actually leading the game. So which are the one that really leading the game is actually on the, if the stock is in January PE 10 to 15 timeframe, right? They get all the way hammered out to 0 to 5 PE range in March. And then their March to June performance is on 92%. So this is the one that actually lift the performance of this range of PE. So then we see that are they by overall, all of them has a very good performance? No, it's also by sector basis. So if you look at January PE on the bottom table, right, on the second row, 5 to 10, where are the best performance? The best performance is actually on the technology side and also on the basic material side. So because no matter how, you still need some basic material. And then who are the laggard? Consumer cyclical still not perform very well, only 46%. Consumer non-cyclical also not perform very well in this region. One of the stock of the energy is actually have a 98%. Oh, sorry, it's actually the third one. I'm looking at the wrong row. So you see that all the performance is actually happened on the technology side. Industrial side slightly okay, and then energy side, some of them rebounded, but then the financial sector are doing good? No. So you can see that there's no it's not a very linear kind of thing that every sector perform well, even though based on low PE. So it's actually more on the sector team focus basis. So you can see that there's no healthcare stock over there. So because healthcare stock is always on the high side. So this will be, I think this will be last slide. So you can actually see more on our analysis on the blog. So my conclusion will be more on the short term wise, probably people will actually look at liquidity. And then on the longer term side, we will have to look at the structural shift. And Dharma Dharan also said that the low fixed cost of the company and ability to change and adapt to the environment is one of the key important things you look at if you want to do a stock pick for now. That's all my presentation.
Okay, thank you, Heng Chuan. I have a few questions for you, but
Okay, sure.
before that, just reminder to all the audience that you can type in your question in the chat, and then we will address the question to the speaker you want them to answer, or even to both speakers, right? So while waiting for questions from the floor, just now, Khai Jhek, you give us you let us to have a dream of what shape the recovery will be. But I mean, it can be either your own personal view or your house view. Is that we are already 8 months into 2020. So looking into 2021, do you think that the base case scenario is to assume that vaccine is not there yet? There's still social distancing, which means that how strong the recovery will be, you know, for the economy as a whole. If there is no vaccine and you still need the social distancing because virus just decided not to migrate to the outer space and stay with us.
Yeah, but so I guess in terms of shape of recovery, I think internally we actually believe it's more of like I guess swoosh shape. It's unconventional in a way. For us, we feel that the recovery will be slow because, like you mentioned, there's still the various social distancing measures as well as some of the restrictions on even like industrial activities. They might also have to continue on this social distancing within the workspace. So even like maybe post RMCO, when it ends by the end of this month, there will still be some form of restrictions just to control the spread of the virus. So we believe like more of a switch in the sense that recovery will be slow. So we were actually expecting the second half growth to actually be close to zero. So it definitely be a recovery from the 17.1% contraction in the second quarter. So maybe a slight contraction in third quarter and a slight positive in the fourth quarter. Then maybe a full rebound in 2021 when maybe a vaccine is found, or even without a vaccine is found, maybe when people start getting used to all the measures, there will be some form of rebound coming in next year. And also plus the low base effect, given this year will likely be very weak in terms of GDP growth. Yeah.
Okay. Heng Chuan, your conclusion, although I know you still were going to conduct further research, but at this moment, the conclusion is that during this type of so-called crisis time, it seems that either you call it sector or thematic normally will perform better over a certain period, maybe 3 to 6 months time. Now, the question is that even within the sector and thematic, how should the investor look into? Should they look for a short-term sector thematic, or they want to look for a longer secular trend? Like, for example, I mean, everybody knows, I mean, it's a matter of fact, like what you mentioned, healthcare has performed very well. But we also very often hear that, you know, if the new norm is there, right, more people will have a remote working, whether work from home or work from somewhere else. And you need more telecommunication infrastructure, even including IoT and all this, where 5G is likely to be a key driver. So how should investor look at, let's say, sector like telecommunications?
Yeah, so thanks for this question. So from investor point of view, right, I think depends on what type of investor you are. So as a CFA charter holder, we actually always have to look at what is your investment objective, and what is your risk profile, and what is your asset base, and what is your investment horizon. So different type of investor will have a different profile. So you may not have actually a one size fits all kind of suggestions. So, but then, I mean, specific to your question on, we have to look at the let's say work from home team, right? And then work AI kind of stuff, and then vaccine kind of stuff. So definitely. So as my point of view, I mentioned just now that since finance and economy are not the root cause this time, it's actually the COVID is the root cause, and then whereas finance, business are actually the victim. So we must always have faith in humans that we can actually innovate. We will actually respond to crisis and come back stronger in an innovative way. So at this moment, we can see that technology stock is actually performed well. And then healthcare stock is performing because due to the new norm, right? Then again, I have to use Damodaran analysis. His framework is say, at the end, you have to come back to the valuation itself. So in the short term, you maybe have some hiccups on valuation. And then after that, you have to look at whether the company can adapt to the new norm or not. So if there's a structural shift in the business environment, right, then can the company adapt to the environment? Then if you look at the fundamental of the company, right, does the company actually can move to a new norm faster? So this is what the Damodaran said, the ability to change and to adapt. And then the second thing he's actually emphasized a lot in his findings is on the low fixed cost. So you must have a business model that actually have a low fixed cost, then you can adapt to the environment faster, then you can actually perform better.
Okay, before I go to Khai Jhek, I just have a follow-up question for you. During your whole research and analysis, have you ever considered using the PEG ratio, that is PE to growth, to see that whether, I mean, put it another way, is PE a good indicator to define growth stock, or you need to look at PE to growth to identify whether this, the so-called growth stocks really perform or underperform during this time of period? I mean, have you ever tried that, or you already have a conclusion that actually PE to growth doesn't work at all?
Okay, so this question to me, right?
Yes, it's to you.
Okay, so we actually based on our analysis, because in the motivation is actually to try to use Damodaran effort. So we try to use as similar as possible. So when he used PE, I also use PE. So so definitely that's another one that actually to look at, right? So if you look at the growth, this is one of the area that we have to look at. Of course, we have to track the earning. We have to track the earning to see that whether the PE and the earning really grow in tandem or not. So definitely in our next analysis, if you are interested to see this data, definitely we include that as well.
Okay. Before I go to the questions from the audience, just one more question for Khai Jhek. Is that actually, how does Malaysia economy compare to our fellow ASEAN countries? I mean, during this period of COVID, although very sure Malaysia did very well at the very early stage to contain the COVID, of course, at a cost that economic activities generally come to a stop. But with now more or less things have stabilized, how is our economy perform? And especially now and looking forward, were we able to perform better than our other fellow ASEAN countries? Khai Jhek?
So I guess in terms of performance, or if you just zone into just the second quarter GDP results, Malaysia is actually among the weakest among like main ASEAN countries. So like Malaysia is like nearly 17.1% compared to like maybe Indonesia is actually contracted by 5.3%, Philippines by 16.5%, which is close to us. So in a way, we can also partly attribute it to, I guess, Malaysia's swift action into in terms of the restrictiveness to contain this pandemic. So I think like I mentioned just during the presentation that a large part of it is due to supply disruption. So the strict lockdowns actually, I guess in a way, destroyed a lot of potential output that should have been gone into the market if not was for this MCO. So it is a positive thing to a certain extent that Malaysia has managed to, I guess, if we discount some of the smaller clusters that we've seen so far, have managed to control the virus. I think we are among the lowest virus cases so far. Like if you compare to maybe Philippines or Indonesia, they have surging cases as of late. So in terms of outlook, Malaysia will likely perform, I guess, better than those that still have to impose some sort of, I guess, strict lockdowns, like say maybe Indonesia or Philippines, due to the virus. So, but I guess the downside risk still comes from the fact that I guess the virus doesn't differentiate between any countries. So as long as, I guess, there is a chance for them to attack, they would. So if we can, I guess the base case, if we can prevent that, or we can prevent going back to that strict MCO that we've seen maybe in March and April or even May, we would likely, I guess, perform relatively well in the near future.
Okay, we have a question from Yi Cheng. I mean, a lot of risk has been mentioned, like US-China trade and all this. This is to both speakers, Khai Jhek and Heng Chuan. I mean, there have been mentioned on the risk of US-China trade and the second wave, third wave, or how many waves we don't know we are going to face. You know, so beside all this, the commonly risks that being mentioned by both of you, any other risk that we are unaware of that we need to pay attention? You know, I mean, it can be really a black swan, or is there some risk that we still, you know, forgot about it? Any other risk that you think we should pay attention to? First, I think, okay, we go to Khai Jhek first.
So I think in terms of risk, I guess the biggest risk so far would definitely be the COVID-19 cases, because that has been on, I guess, the front page every other day. But in terms of unaware, I guess I will always come back to I guess the COVID situation, given that because Malaysia is actually quite, I guess, integrated into the global supply chain. So even if Malaysia doesn't see an increase in cases, if like other main manufacturing or even main countries like maybe the US or even China see a surge in cases, that would also affect Malaysia's performance moving forward. Given like say maybe US and China, I believe is the largest I guess source of destination of Malaysian output in terms of exports. So that would have some multiplier effect into Malaysia's outlook into going ahead. Yeah.
Heng Chuan, anything you want to add?
So for me, most of the risk that we actually flagged over during this presentation is more on the short-term risk. So on the longer-term side, since that if there really a new norm, right, in a structural shift, so can our business and our economy in Malaysia adapt to it? So we have the capability to switch to more on the AI technology sides, and also like healthcare. Besides some of the manufacturer, do we want to beef up our capability on healthcare as well? And also our other sector that you need to lesser reliance on the labor market, foreign labor market. And also we have to actually look at the sales sustainability. Like if you have ever other lockdown a country, our food security are sustainable. So all these things, these are the structural change that we need to look at and longer. So not on the short-term period, but longer period, see whether Malaysia can continue to grow or not. So these are the risks on the longer term.
Okay, just a follow-up on that for both of you. I'm looking a little bit on the more optimistic side. Let's say, you know, things are back to normal. What about the risk of actually reverse QE? That means whether you call it QE or normalizing the interest rate. I mean, the market and partially economy also is being driven by excess liquidity. So is there a risk on normalizing interest rate or reverse QE? Or even before that, if suddenly the economy recover and then the world or part of the world go into a high inflation space? I mean, is this a risk that we need to pay attention to, or like some people has been saying that probably the world will be in a very low interest rate for a very prolonged time, that we don't have to bother about this, don't have to even think about that, and just take advantage of the low interest rate and accumulate your wealth and asset as much as you can.
Yeah, so I
Okay,
think okay, let me do it. Okay, I think some of the big names investor actually already respond to that. I think lately you will see that Warren Buffett falling. So in order to hedge against the inflation, whatever, so where you go? So you actually go into gold. So you see gold also go up very high lately, right? So there are definitely some people actually looking at this risk as well. So different investors may have different view right now. So we really do not know when this will happen. But definitely this is the risk that we have to look on, and then we also have to see who is actually heading the Fed. So if they do it gradually, then probably the impact will not be that bad. If they don't control it very well, then we have to factor in this impact to the negative impact.
Okay,
Khai Jhek, you want to comment on this or not?
Yeah, but just to add, I guess to a certain extent, I guess the global financial market is kind of getting used to this low interest rate environment, because I guess if you take into the most recent, event where there is a reverse in terms of stepping up the excess liquidity in the market. I think there was a taper tantrum back in 2015-ish. I mean, that just the news itself already, I guess, generated quite a lot of shocks to the market. But I guess the market just needs time to get used to, I guess, the gradual, maybe the gradual reduction of QE purchases, or after that maybe a gradual increase in US interest rates. But in terms of the real economy, the impact towards Malaysia is unlikely to be that significant. I would expect it to be mostly contained within the financial market. So we might see more financial outflow from maybe the bond and even the equity market in Malaysia. But I would believe that the Fed would try to, I guess, minimize the shocks to the market. Yeah.
Okay, we still have time for a question or two. So fellow participants, feel free to write your questions in the chat. So just a follow up on Khai Jhek. I mean, during this totally unusual and unprecedented time, government has tried all their best, in terms of the stimulus, in terms of whatever measures like loan moratorium and all this. Do you think currently all these measures are relatively effective, or they need to do more? Because there has been also talks that, like you mentioned on the social distancing, even Heng Chuan also mentioned, if this is going to continue for another 3 months or more, there have been talks that, some SME, SMI, where you are the expert in the rating side, may go into trouble, right? But if a further extension of all this moratorium may also bring the banks into a very challenging position. So do you think that currently all the government measures are enough, or government to do more, or extend the moratorium for another 6 months or 12 months?
In terms of the government measures, I think they are responding towards all the, I guess, issues in the economy, which is quite an encouraging, I guess, response from the government. However, whether is it enough, I think only time will tell, because in the sense that, like, we do see that they've gone very targeted. Like, say, if I guess most of the impact are on low household income, the cohorts, they have done some like targeted measures, like maybe give some cash transfer, the Bantuan Prihatin, or even the Bantuan Prihatin Electric. All those are actually direct support towards the most vulnerable households, and that will actually at least help to support the economy. And other than that, there's also like even risk of job losses, so they introduced the wage subsidy program. Those are quite I guess, a move in the positive direction. I guess whether is it enough would really depends on the take-up rate of maybe the businesses, like in terms of wage subsidy, or even how well would be the sectors actually recover post maybe the gradual reopening after the restrictions.
Okay, Heng Chuan, I have one question for you. Of course, I don't know whether you are planning to do this type of independent research or not. I think you're probably aware that I think it's about 2 years ago in 2018, McKinsey come up with a report, so-called identifying the top 500 companies in the world, arguing that this company will become stronger and stronger, which I mean for investor, which means that the remaining of companies is doesn't that worth for a long-term investment. And one of the key valuation approach that they use is EVA, economic value added. Do you think EVA is a good valuation methodology for investor to look at a longer term investment horizon?
Yeah, definitely this is one of the area of looking at it. But then my view on EVA is there's a lot of qualitative assumption that you have to actually bake into it. So because my personally is actually more on a quantitative guy. So I actually are looking more on the data itself, and then we try to analyze based on the data. Definitely we can actually take time to looking at it into that area, but currently all my focus will be more on the quantitative side, and then also more on the discounted cash flow side. My research methodology will be more on the Darmo-Darren kind of but definitely I can take a look on that.
Okay. I think, okay, I have one more question for both of you. I mean, we are not going to predict who will be the next president, but do you expect there will be a big shift? Because both of you also mentioned about US-China trade relationship, or even, I mean, some people are talking about it's a Cold War, but do you expect things will become more serious? That means the conflict will become more and more serious post-US presidential election, irrelevant of who will be the next president. And what does that mean to the global economy and probably to Malaysia as well? Okay, Heng Chuan, you take the question first.
Yeah, as I mentioned previously, we say I have faith in humanity. So I always look for because I'm not sure who is going to win, and then what are the policy that they're going to implement the relationship, right? But I will always hope for a better relationship, and then probably better than what we have right now. At least they agreed on something and then get things keep going. So this is my heart. Even Warren Buffett said that always have hope on nothing will stop America, right?
Okay. Khai Jhek, how about you?
Yeah, I agree that nothing will stop America, but then, but I guess to a certain extent, I guess we have seen like in most recent past, at least if we use the US-China most recent trade agreement as a gauge, I guess there is some sort of balance as to how serious would the US actually wants to go into in terms of the conflict. I guess maybe like even trade tariffs are, even though damaging, they are acceptable, but I guess more than that, I'm not sure if they are willing to go towards that step. But at least you can see that both sides are actually willing to go to the negotiation table to actually come up with a solution rather than just going for that tit for tat kind of trade tariff war. So if the first trade agreement is a good start, maybe they might hopefully, if Trump is not in a bad mood, then they might go for a second trade agreement to at least, I guess, resolve the conflict that they have so far between both parties. Because it can be argued that I guess China is quite a big threat to the US global, I guess, economic supremacy to a certain extent. So just whether if both of them can come to a middle ground. Yeah.
Okay, just a follow-up on this for both of you. If we are taking a positive view on this US-China trade relationship, can we still expect Malaysia to benefit from the so-called, for a while, there has been talking about Malaysia want to benefit from the relocation, reviewing of the supply chain and all this. So if US-China relationship are improving, can we expect Malaysia to benefit from the relocation of the factories, or Malaysia have to find its own way to survive through when these two giants are having a better relationship? In terms of what Heng Chuan say,
maybe KJ,
you know,
KJ go
move
first
out
as
the
well.
technology change.
But
Okay,
yes, one thing that the US-China trade conflict has shown is that I guess most of the company, or even the COVID pandemic actually showed that people are wary of the concentration risk. So if you look at the browse the news, there's been a lot of news that like most of the big companies are actually trying to diversify their production hubs. So like some people are moving to Vietnam and some are moving to India. So to a certain extent, we over the longer term, we would still benefit from maybe some trade relocation or even trade diversion. If like factories in China doesn't buy from us, maybe some of the new plants set up in Vietnam or even Thailand or even in India can actually source from Malaysia. Or even better, some of the factories could actually relocate to Malaysia, then we would benefit from it. But over the very short term, during this, like I guess, relocation period or even this conflict period, there would be some disruptions towards demand from Malaysia.
Okay, Heng Chuan, anything you want to?
Yeah, I think I have the same view. So that because previously for past so many years, they actually concentrated on China as a manufacturing hub, right? So this actually start to create during the pandemic time that once China stopped, everybody stopped. They can't move, right? So I believe all the other businesses, they will actually start to look at self-sustainability, how to actually grow the supply chain within their country or within a region, right, in order to reduce the disruption. So definitely, even though you said, I think regardless of whether US and China relationship will become better or worse, right, this will be the trend. So people will start to look at how to balance up all their supply and change all the network.
Okay, thank you very much. While I'm summarizing the both speakers' key takeaway, I think CFA Malaysia has a questionnaire or some feedback, online feedback that hope that all the participants can fill up. I think Sikin probably will switch the screen to ask you all to put the feedback. So as a summary, I think first is Khai Jhek has shared with us that, second quarter for Malaysia probably is the worst. Then after that, it will gradually recover. But all in all, this year, we are still seeing a negative growth of probably 4% as a base case scenario. And then next year onwards, probably things will be better. And he doesn't see that US-China trade relationship will become a really full-blown and totally tear the world apart. Whereas Heng Chuan, he shared with us that essentially there is no clear factors that really tell you can benefit all the way during this crisis level. Low PE stocks are a little bit more resilient and defensive during the fall, but during the upturn, actually it's the other way around. And dividend yield also, it doesn't seem to be defensive at all during the period of this type of crisis. And probably we hope that he can do some other further research to help our, not just only our fellow CFAs, but also for the general public. And we hope he can publish some research to be published in the CFA Institute as well. And we can be proud of Malaysia as well. Okay, so with this, I don't see there's any further question from the audience. May I pass the mic back to Shiji? I don't know whether she wants to make some conclusion remarks or not. Shiji, back to you.
Yeah, thank you. Yeah, thank you, Mr. Phua. Actually, I don't have much conclusions, but I see the situations like COVID-19 is like going up and down, turns back and then turn worse. So hopefully you all stay safe and stay healthy lah. Okay.
I thought you want to remind
Thank you everyone for dialing in tonight.
Shiji, I thought you want to remind everybody to pay the dues for those who haven't paid.
Yeah, those who haven't paid, remind you all to pay.
Okay, thank you very much.
Thanks, everybody.
Stay safe.
Thanks.
Stay safe.
you.
I mean, virus does not disappear. So